March 2008. Bear Stearns collapses in 72 hours. September. Lehman Brothers disintegrates overnight. The global banking system freezes. Credit markets lock. Trillions of dollars in perceived wealth vanish in weeks. And then, just as the world teeters on the edge of total collapse, governments step in. They flood the system with cash. They guarantee everything. They rescue the banks, stabilize the markets, and tell the public the worst is over. But here's what they didn't tell you. They didn't fix anything. They bought time. They paused the collapse, transferred the risk, and built a bridge over a canyon they refused to measure. And for 15 years, that bridge has held. Just long enough for everyone to forget how close we came. Just long enough for people to believe it can't happen again. But the pattern that broke the world in 2008 has quietly returned. The same leverage, the same hidden fragility, the same structural rot. Only this time, there's one critical difference. The safety net that caught us last time no longer exists. By the end of this video, you will understand what really happened in 2008, why the rescue worked then but won't work now, and what to watch as the next phase unfolds. This is not speculation. This is pattern recognition. I'm a former risk analyst. I've spent years inside the machinery of credit markets, studying central bank operations, sovereign debt dynamics, and the mechanics of financial collapse. What I'm about to show you isn't based on opinion. It's based on official reports, central bank data, Treasury statements, and the historical record of every major empire that tried to print its way out of structural insolvency. This is educational content, not financial advice. But if you care about your savings, your security, or your ability to navigate what comes next, you need to understand the mechanism at work. Here's the map. First, we're going to strip away the myth of 2008 and show you what actually happened behind closed doors. Second, we'll examine the tool that saved the world back then, quantitative easing, and why it's no longer a solution but a trap. Third, we'll walk through the hidden cost of 15 years of bailouts, moral hazard so deep it's become policy. Fourth, we'll show you why the fiscal margin that made rescue possible in 2008 has completely evaporated. Fifth, we'll reveal the endgame mechanism already written into law, bail-ins, where your deposits become the collateral. And finally, we'll identify the 3 stages of collapse, show you where we are now, and give you the watch list of indicators that signal the transition to the next phase. Let's start with the lie you were told about 2008. The official story is simple. Reckless bankers made bad bets. Housing prices collapsed. A few over-leveraged institutions failed. Markets panicked. Government stepped in, stabilized everything, and the system recovered. Crisis averted. Lessons learned. Regulations tightened. That narrative is designed to make you feel safe. It is also completely false. 2008 was not a banking failure. It was a systemic exposure event. The entire global financial architecture, built on decades of leverage, securitization, and faith, came within hours of total disintegration. What the public saw as a recession was, internally, a near-death experience. Major institutions were technically insolvent. Interbank lending froze. Collateral evaporated. The plumbing of modern capitalism seized. Treasury officials and central bankers were not managing a downturn. They were preventing the collapse of money itself. Here's what actually happened. In the years leading up to 2008, banks had transformed from lenders into leverage machines. They took deposits, turned them into securities, sliced those securities into derivatives, and sold them worldwide. The system worked as long as housing prices rose and default stayed low. But when default spiked, the chain broke. Suddenly, no one knew what anything was worth. Banks stopped trusting each other. Credit vanished. And the institutions everyone assumed were solid turned out to be shells built on borrowed confidence. Lehman Brothers held over $600 billion in assets. When it failed, the contagion spread instantly. AIG, the world's largest insurer, required a $180 billion bailout. Citigroup, Bank of America, Morgan Stanley, every major name faced insolvency or liquidity death. The Federal Reserve didn't just lower interest rates, it became the lender of last resort to the entire planet, extending emergency credit lines to foreign central banks, backstopping money market funds, and guaranteeing trillions in toxic assets. This was not policy. This was resuscitation. And it worked, not because the system was saved, but because the belief in the system was restored. Policymakers stabilized the patient without treating the disease. They didn't reduce leverage. They didn't purge bad debt. They didn't restructure anything. They flooded the zone with liquidity, reassured markets, and prayed confidence would return before the truth became visible. It did. And the world moved on, convinced the danger had passed. But 2008 wasn't a crisis that ended. It was a controlled simulation of what collapse looks like, and a demonstration of how much intervention is required to reverse it. The rescue worked once. The question is whether it can work again. And to answer that, we need to understand the weapon they used, quantitative easing. Quantitative easing sounds technical, almost boring. It's anything but. QE is the mechanism by which central banks create money out of nothing, use it to buy government bonds and toxic assets, and inject liquidity directly into the financial system. In theory, this stabilizes markets, lowers borrowing costs, and stimulates lending. In practice, it's a wealth transfer from savers to asset holders, a debt concealment program, and a political escape hatch that allows governments to spend without immediate consequences. After 2008, the Federal Reserve launched multiple rounds of QE, expanding its balance sheet from under $1 trillion to over $4 trillion. The European Central Bank followed. So did Japan. So did the Bank of England. By 2020, central banks worldwide had created more than $20 trillion in new money. And the public was told this was temporary, surgical, and necessary. It was none of those things. QE does not eliminate debt, it transfers it. The losses that should have been absorbed by failed banks were absorbed by central banks. The risks that should have been purged were recycled into government balance sheets. The bad debts that should have died became permanent public obligations. This is the trick. QE makes insolvency invisible by replacing it with inflation risk and sovereign fragility. It works as long as people believe the central bank can always print more. But belief is not infinite, and every round of QE weakens the next. The Federal Reserve's balance sheet is now over $7 trillion. The Bank of Japan owns more than half of its own government's debt. The ECB is trapped in a cycle where any attempt to tighten policy threatens to destabilize entire member states. These institutions are not stronger than they were in 2008. They are more leveraged, more exposed, and more dependent on the very tool that got them here. Here's the core mechanism you need to understand. QE buys time, not solvency. It delays restructuring instead of enforcing it. It inflates asset prices while doing nothing for productivity. And it creates a system where every crisis requires more intervention than the last. In 2008, central banks expanded by trillions and markets stabilized. In 2020, they expanded by even more and barely kept pace. The next crisis will require an intervention so large it may destabilize the currency itself, which brings us to the hidden cost of all this: moral hazard. Moral hazard is the idea that if you protect people from the consequences of risk, they take more risk. In finance, this principle has been weaponized. For 15 years, investors, banks, and governments have operated under one assumption: when things break, someone will step in. Central banks will print. Governments will guarantee. Losses will be socialized. Profits will remain private. This is not capitalism. This is a subsidy program for recklessness disguised as prudent policy, and it has transformed the global economy into a machine that punishes caution and rewards leverage. Look at the evidence. Since 2008, corporate debt has exploded. Zombie companies, firms that cannot cover their interest payments from operating income, have proliferated. Speculative bubbles in technology, real estate, and cryptocurrencies have inflated to levels that dwarf previous cycles, and none of it has been purged. Every time a correction begins, central banks intervene. Every time defaults rise, governments step in. The message is clear: risk has no downside. This is why the system today is more fragile than it was in 2008. The leverage is higher, the derivatives exposure is larger, the interconnections are deeper, and the belief that rescue is automatic has become embedded in every pricing model, every investment decision, and every political calculation. But moral hazard only works when the rescuer is credible, and that credibility is gone. Which brings us to the central problem. In 2008, the United States had the fiscal space to save the world. Today it does not. Bailouts require three things: borrowing capacity, political consensus, and market confidence. In 2008, the US possessed all three. Debt to GDP was below 70%. Interest payments were manageable. Congress was divided but functional enough to pass emergency measures. And global investors still viewed US Treasuries as the ultimate safe asset. That combination allowed the government to absorb trillions in losses, backstop the banking system, and reassure markets without destabilizing its own finances. The rescue worked not because the system was healthy, but because the state could afford to pretend it was. That world is gone. Since 2008, U.S. federal debt has more than doubled, surpassing $36 trillion. Debt to GDP now exceeds 120%. Annual deficits run over $2 trillion, even during periods of supposed growth. And interest payments on the debt have exploded, now consuming over $1 trillion per year. More than the defense budget, more than Medicare, and rising faster than any other line item. This is not a temporary problem. This is a structural trap. Every new dollar of debt costs more to service. Every basis point increase in yields adds billions to the annual burden. And every emergency intervention accelerates the trajectory. Here's what this means in simple terms. If another 2008 scale crisis hit tomorrow, the government would need to borrow several trillion dollars just to stabilize the banking system. But that borrowing would flood the bond market at precisely the moment when investors are fleeing risk. Yields would spike. Borrowing costs would explode. and the fiscal position of the United States would deteriorate so rapidly that the rescue itself could trigger a sovereign debt crisis. This is the paradox. The tools that saved the world in 2008 are now the tools that could break it. And it's not just fiscal space. Political unity has collapsed. In 2008, Congress fought over TARP, but ultimately passed it. Today, legislative gridlock is permanent. Trust in institutions has evaporated, and any large-scale bailout would face immediate populist backlash from both left and right. The window for sovereign rescue is not just narrowing, it has already closed. So what happens when governments can no longer bail out banks? The system turns to the final option, taking the money directly from you. This mechanism is called a bail-in. Unlike a bailout, where the state injects capital into failing institutions, a bail-in forces depositors, bondholders, and unsecured creditors to absorb the losses. Your savings are converted into bank equity, your deposits become the collateral, and the institution survives by sacrificing the people who trusted it. This is not theory, this is law. Bail-in frameworks have been written into the financial architecture of the United States, Canada, the European Union, and the United Kingdom. The language is careful: resolution regimes, orderly liquidation authorities, systemic risk buffers, but the function is identical. When a bank fails and the government cannot or will not rescue it, your money becomes the Ju Sheng Fa. History gives us two clear demonstrations. The first was 1933. During the Great Depression, U.S. banks closed en masse. Withdrawals were frozen. Customers discovered almost overnight that their deposits were not truly theirs. They belonged to a system prioritizing survival over individual access. The public accepted the shock because the crisis was overwhelming and because Roosevelt's government still commanded credibility. But the lesson was clear. When the system is at risk, personal property is expendable. The second demonstration was Cyprus, 2013. The banking system collapsed under bad loans and speculative excess. There was no fiscal room for rescue. The European authorities imposed a solution: seize deposits above 100,000 euros. Ordinary citizens, small business owners, retirees, families, lost savings accumulated over decades. Protests erupted, banks were surrounded, but the policy held. The message was unmistakable. When governments cannot save banks, citizens pay. Today, the structure for this already exists. In the US, the Dodd-Frank Act contains provisions for orderly liquidation that allow regulators to convert deposits into equity during systemic crises. In the EU, the Bank Recovery and Resolution Directive does the same. In Canada, bail-in powers were quietly legislated in 2013. These are not emergency proposals. They are standing law, waiting for activation. Most people assume deposit insurance will protect them, but deposit insurance funds are tiny compared to the liabilities they promise to cover. The FDIC's deposit insurance fund holds around $120 billion. U.S. bank deposits exceed $18 trillion. If even 2 or 3 major institutions fail simultaneously, the guarantees evaporate. Insurance cannot stop systemic collapse. It can only soften isolated failures. This is the silent truth. In the next crisis, your savings will not be rescued. They will be reclassified. You will not be protected. You will be used. And the system will present this as the responsible choice, the orderly solution, the least bad option. But make no mistake, it is confiscation by another name. Which brings us to the final question: where are we now, and what happens next? Every empire follows the same pattern. Stage 1, dominance. The reserve currency, the trusted institutions, the belief that the system is permanent. Stage 2, overextension. Wars, spending, deficits, and debt accumulate faster than growth. Stage 3, quiet rotation, smart money exits. Foreign reserves diversify. Confidence erodes slowly, then suddenly. Stage 4, the break. Devaluation, default, or restructuring. The empire doesn't collapse all at once. It fragments, then fades. The United States is in late stage 3. The signs are everywhere. Foreign central banks are reducing Treasury holdings. China, Russia, and other nations are increasing gold reserves and building alternative payment systems. The dollar's share of global reserves has declined steadily for 2 decades. U.S. allies are quietly hedging their exposure. And domestic trust in institutions, government, media, finance has collapsed to historic lows. These are not coincidences. They are symptoms of a system losing legitimacy. Here's your watch list. 3 indicators to monitor closely. First, 10-year Treasury yields. If yields spike above 5% and stay there, it signals that markets no longer trust U.S. solvency at current debt levels. Second, the dollar's share of global reserves. If it drops below 50%, the transition to a multipolar currency system accelerates irreversibly. Third, bank stress indicators. Watch the FDIC's problem bank list, commercial real estate default rates, and unrealized losses on bank balance sheets. If these converge, the next wave begins. Timeline. Near term, within 12 to 24 months, watch for regional bank failures and commercial real estate distress to intensify. Midterm, within 3 to 5 years, expect sovereign debt concerns to move from the periphery to the core, meaning US and European bond markets face sustained pressure. Long term, within a decade, the probability of a forced restructuring or monetary reset rises significantly. The direction is firm, the timing has uncertainty bounds, but the mechanism is already in motion. So what do? I can't give you financial advice, but I can share principles. First, diversify out of concentrated dollar exposure. This doesn't mean abandon dollars entirely, but understand that holding 100% of your wealth in any single currency or system is a concentration risk. Second, reduce dependence on institutions you cannot control. Banks, brokers, and custodians operate under rules that change during crises. Third, build liquidity and resilience. Cash, skills, relationships, and geographic optionality all matter when systems fracture. Fourth, understand duration. Long-term bonds and fixed obligations become dangerous when interest rates are unstable. Fifth, do not assume deposit insurance will save you in a systemic event. It won't. And sixth, avoid the mistake of believing this time is different. It never is. The patterns repeat, the names change, the outcome remains. Here's what not to do. Do not panic. Do not make impulsive decisions based on fear, and do not assume you can time the exact moment of transition. No one can. The goal is not to predict the future. The goal is to position yourself so that when the bridge finally gives way, you're not standing on it. Let me close with this. In 2008, the world learned that the financial system could be saved. Governments mobilized trillions, central banks printed without limit, markets were stabilized, institutions were rescued, and the public was told the system was now safer, more regulated, more resilient. That narrative worked because people wanted to believe it, but the truth is simpler and darker. The rescue worked in 2008 because the tools were still credible, the debt was still manageable, and the political will was still intact. None of those conditions exist today. The institutions that absorbed the shock are now the source of it. The governments that provided rescue are now overextended. The central banks that printed stability now risk printing panic. And the public that accepted extraordinary measures is fractured, skeptical, and unwilling to bear the cost again. In every historical cycle, the first rescue is dramatic, the second is controversial, the third is impossible. We are entering that third stage now. The next crisis will not be delayed, softened, or reversed. It will be revealed. The mechanism is already in place, the pattern has returned, and the safety net that caught the world in 2008 is gone. They saved the banks once, they saved the markets once, they saved the system once, they won't again. If this analysis helped clarify the mechanism, hit subscribe and drop a comment. Which signal are you watching most? Yields, reserves, or bank stress? Let's see where the crowd is focused. This is educational content, not financial advice. Do your own research and consider professional guidance. But whatever you do, don't assume the bridge will hold forever. It won't.